Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 31st, 2024. And we are through 5 months of the year. And this week's video is titled Software Stocks Crumble on Weaker Growth Expectations. That was kind of the big news from a sector perspective, and we'll dig into that in a minute. But I'm host Justin Klein, host of InvestTalk, Justin Klein. And I thank you for liking and subscribing to this video, as well as our podcast, InvestTalk. Now, let's look at the economic numbers this week. Financial conditions index did ease again down to negative 58. Remember, negative is looser policy. And you see that was very loose back in 2021 and 2020, early 2022. And we're back to kind of those levels. So no tightening of financial conditions as of yet. And that's why it's hard to really imagine a major pullback in equities, but you could enter a soft period going forward, which we'll talk about here in a minute. Now, let's look at the economic news. The Richmond Fed Manufacturing Index that came in flat from many months in a row of negative territory. So manufacturing side of the economy is improving slightly. The continuing claims for unemployment, that one came in about flat as well. You still are remaining kind of in this 1.8 million continuing claims number, which we've been in since the fall. So I would say the labor market isn't getting weaker or better. It's just kind of steady state at the current time. Real GDP growth in the first quarter. Now, this always hits headlines, but I always think it's overblown. But it's something I'm sure the Fed is looking at. And the reason I say it's ever overblown is because it's backward looking, right? You always want to look at things that are at least showing what's happening now and ideally leading to economic activity in the future. This is in the past. Now, could this mean the Fed is more apt to cut rates versus raise rates because only 1.3% of real GDP growth is not amazing? It's probably the neutral long-term growth rate for the economy, but not a condition that the Fed probably wants to aggressively hike into. And so, while some Fed members have been talking a little more hawkishly lately, I still don't think that they are ready to raise rates anytime soon. They're still looking to cut rates, and this is one thing to kind of help with that. Pending home sales, that did tick down to negative 7% year over year. 30-year rate did tick up to over 7% once again. The Chinese PMI numbers, that did come in negative territory in their PMI. Their non-manufacturing, 51.1, about flat on the month. But obviously, China's economy is far different than ours, right? They have a manufacturing-focused economy where we have the non-manufacturing sector is more important here. It's kind of flipped in China. So you're seeing their economy, if you're focusing just on the PMI, it's once again kind of steady state, not terrible, not amazing, but the Chinese party wants the economy to be making headway, and it's just kind of not. Now, the PC number that came in on Friday, I think it was under discussed, but it did come in slightly down from the previous month on the core. Same thing with the regular PCE number, and the 12-month trim mean PCE inflation rate, which is the one the Fed focuses on probably the most, is below 3% again. Now, that's still elevated from pre-COVID levels of 2%. So elevated inflation, and I think it's going to continue to be hard for the Fed to get all the way down to that 2% rate. So they're going to be battling between letting inflation run a little hot and trying to cut rates to juice the economy. I think they'll err on the side. Sorry, increase rates in order to shrink the economy and get inflation down. I think they'll err on the side of inflation, allowing inflation to stay up here. So that's why they're focusing more on cutting rates as opposed to raising rates. I already showed you this, but here is the end result this week of the expectations of the market for the Fed, and that is 1.5 cuts, basically between now and the end of the year. And we only have 5 meetings, right? There's only 5 meetings. So that's basically 1 to 2 of those. 5 are going to be a rate cut. A lot will depend on the economy going forward. But when you look at something like this, they're not in a huge hurry to cut rates because the that would help the financial conditions ease even more, and they don't really want that. So I think you're going to have to see a tightening of financial conditions before they start to actually bring rate cuts forward. Okay. Now let's touch a bit on the markets here. Look at the S&P. That was up a pretty nice reversal on the day into the week close. Reversal from the 50-day moving average. That is the red line here. But mainly I want to focus on this. And this is really the lesson for the week, which is this IGV. This is the software ETF. And if you go across the SaaS software environment from companies like CRM, Salesforce, that was the main one that sparked a sell-off. And it was all about not bad growth, just worse growth than the market had been expecting, right? That companies were prioritizing AI development, AI infrastructure, and capex versus buying new seats and upgrading their software. Okay, and so that's why their growth expectations going forward are weaker, and that hit the stock. And remember, when you that's what's happening here across the board. You go to Now, right? Services Now, that was down big. Vive Systems, go, Viva Systems, excuse me. That went down big on Thursday and Friday. That had bad earnings as well. Then you have stocks like Adobe and even Microsoft and even Amazon, that have these cloud service offerings. Those are ones I think that are in threat, and obviously they are a big part of the broader index. So if they follow suit and their multiples start to shrink because of expectations of lower future growth, that's going to weigh on the broader market. Okay, and the Qs on Friday, those were down, even though it did close well off the lows. But what you can see here is, right, is there a MACD divergence? Yeah, there is. Okay, and you see here is on the weekly for the Qs. And was this a reversal bar? Oh, it was. Yeah, that was a wide-ranging reversal bar on higher volume. Let's go to the COMPQ. Okay. Zoom in here as well. You're getting a MACD divergence. This one didn't have quite that reversal. The NDX, that's the Nasdaq 100, that's the Qs. So it's going to have the same type of pattern there. So definitely an interesting week. And mainly it's this. Let me go here. I'll show you this chart of the growth versus value. It threatened a breakout here. This is the weekly. But a big reversal, right? You have this consolidation phase, and it was threatening to break out. And this would be a failed breakout. And this would be very bearish. If it does not hold this breakout level, this is likely headed way down here and maybe even lower. And it would flip the market leadership from those growthier names that have outperformed since the beginning of last year, generally, to the value side, which started to show its chops. So here, this is the growth of value trade. So when this is going up, growth is outperforming. This is the beginning of last year, right? 2022, growth drastically underperformed. 2023, snap back. And then you got the start of the rollover in the fall, a reversal here to start the year, and a consolidation phase. And this is failing that breakout. So that is probably the biggest story in markets right now underneath the surface. Okay. And you had some strength in energy as we close the week. We have the OPEC meeting this week. That's tomorrow. So that'll be interesting to see what that looks like. Materials, you're seeing that really close to the highest levels on the week. Okay. Industrials, take a look at industrials. Also, pretty nice reversal. Right? Much better. I'll do this. Look at industrials with the Qs. They were underperforming. Now you're looking like this wants to flip here. Okay, so the tech side of the market, while it had a good 2023 and a good start to 2024, that rotation, it looks to be over, or at least close. If you go to close below, last week's low, it should be on this ratio about 1.4, 1.49. Then that's going to really tell you that this is this bear flag, and that's what this is, right? You have this move down, you have a lower low, right? Three lower lows, a counter trend rally, three highs, one, two, three highs, and a rollover. Things happen in threes oftentimes in markets. And so this is something it's very interesting to watch this. And you see this high volume as well on this week. So that's definitely top of mind when I am looking at sectors at the moment. Okay. And let's take a look at the credit markets. You have that hanging in there, right? We know that if this is headed higher, this is kind of similar to the financial conditions index, showing that there's no real threat of a major credit event. Okay. Gold did have a pullback this week. Obviously, was a bit overbought. You did get a bit MACD divergence here, that showing you that this probably needs a bit of a pullback. Would it pull back to the 100-day moving average? Would not shock me at all. You look at something like the GDX, that one getting a bit of pullback as well. But obviously, this is now making higher highs and higher lows, still in a relatively bullish phase. The MOVE index. So he's talking about this. This is in a downtrend. So no real worries. This is the volatility index for the treasury market. No real worries on that front. Let's take a look at the regular VIX. That one remains relatively low, and that's what you're likely to see here, right? What you're seeing is the VIX is low, the credit markets are fine, but rotation underneath the surface. And so what this kind of tells you is that you're probably going to get a choppier period. Not a big bear market, nothing that's widespread, terrible about the economy or terrible about earnings. It's just a market leadership change and a shift in the way that the market is acting, and that happens. No, every year is a bit different. We're heading into the election season as well, and that'll be top of mind for investors. But right now, what's top of mind is really that maybe shift in the narrative, moving money out of those software names and into the AI plays. Now, Nvidia did take off this week. It held that rally. We'll see a little bit of sell off the last couple of days. The SMH was had a couple of weekdays. If you look at like an AMD, that didn't get quite the rally there. Qualcomm, that one had a nice week as well, but had a bit of a reversal. So I think the semiconductor names could pull back with it. You got a name, we actually own this for clients, HPQ, that kind of broke out. So there's some catch up, some names that are catching up in the AI space, realizing that, hey, AI, those that will benefit from AI are not just those that are the NVIDIAs and the SMCIs of the world, that there are other winners as well that will come and chase the leadership. And they're going to develop products that also could fit for certain applications. So, and that could mean a change in leadership as well, right? Those names that are cheaper, maybe underloved, underappreciated of their AI play, they could get a rally versus money that's already deployed to the NVIDIAs and others are maybe valuations might be a bit stretched, and so that seems to be what is happening underneath the surface. So I wanted to give you that update in markets. Let me see if there's anything else that I can think of. No, I think that's about it. We'll see what happens with OPEC meeting, and next week we said, and we're only a couple weeks away from OPEX, right? OPEX week is coming up too, and that's quarterly OPEX, and that can be a big market mover as well. And remember, QT gets downshifted on Monday, and that is from 60 billion to 25 billion a month. So that will be interesting to see how the market reacts to really the first Fed policy shift, and that's what it is in earnest. So that's where we're at. I expect a choppy period going forward and a lot of market rotation. So thank you all for tuning in, and a reminder that the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.